April 2024 marked Bitcoin's fourth halving. Block rewards dropped from 6.25 to 3.125 BTC automatically by code with zero human intervention. Daily new supply fell from 900 Bitcoin to 450. Yet prices didn't explode. They never do immediately. History shows the real moves happen 12 to 18 months later, meaning 2026 sits directly in Bitcoin's historical acceleration window. But this cycle operates under completely different market mechanics than any previous halving. Welcome to the Crypto IQ. Today we're exposing what 2026 actually looks like after the halving. Why spot ETFs rewrote Bitcoin's supply dynamics. How miner behavior shifted from forced selling to balance sheet strategy. And the macro forces now controlling price action more than retail speculation ever could. Bitcoin halvings occurred in 2012, 2016, 2020, and 2024, each cutting new supply in half. The 2012 halving reduced rewards from 50 to 25 BTC. In 2016, rewards dropped to 12.5. The 2020 halving brought them to 6.25. The pattern holds. Supply shocks take time to materialize. After every previous halving, Bitcoin traded sideways or declined for months before rallying. The 2012 cycle peaked 378 days post-halving. The 2016 cycle hit all-time highs 526 days later. The 2020 halving delivered peak returns around 546 days after the event. Markets don't react instantly. They absorb supply changes slowly, then explosively. By 2026, Bitcoin will be roughly 24 months past the April 2024 halving, placing it historically in consolidation territory rather than parabolic growth. In 2014, 2018, and parts of 2022, the second post-halving year brought cooling after rapid expansion. But 2026 isn't 2014 or 2018. The market structure changed fundamentally. The halving hits miners hardest. Revenue instantly drops unless price or fees compensate. After the 2020 halving, inefficient miners shut down equipment, hash rate temporarily declined, and consolidation began. Publicly listed mining firms raised capital, merged, or exited entirely. Following the 2024 halving, miner behavior shifted again. Public disclosures showed focus on efficiency upgrades, lower energy costs, and balance sheet management. Some firms cut daily Bitcoin sales entirely. Others used hedging strategies or debt financing instead of selling spot holdings, reducing immediate supply hitting exchanges compared to earlier cycles. This matters because miner selling historically represented a constant supply pressure. When weaker miners exit and stronger firms stop selling, one major source of downward pressure disappears. By 2026, consolidated mining operations with stronger balance sheets should exert less selling force than in any prior post-halving period. In January 2024, spot Bitcoin ETFs began trading in the United States, the single biggest market structure change in Bitcoin's history. No spot ETF existed during the 2012, 2016, or 2020 halvings. By mid-2024, ETFs held hundreds of thousands of Bitcoin, with daily inflows varying, but introducing steady demand tied to traditional capital markets. ETF shares are backed by physical Bitcoin held by custodians. When inflows occur, Bitcoin is purchased on the open market. This demand mechanism didn't exist in prior cycles, which relied on retail trading, crypto exchanges, and speculative flows. ETFs changed how supply is absorbed. Instead of rapid price spikes attracting buyers, Bitcoin can now be accumulated slowly through pension funds, asset managers, and long-term institutional investors. A senior ETF executive told Reuters that demand from registered investment advisors was structural, not speculative. Another fund issuer stated ETF investors tend to rebalance quarterly, not daily, reducing reactionary selling during market stress. This behavior fundamentally alters volatility patterns. Bitcoin's volatility profile has declined over successive cycles. Large drawdowns still occur, but depth and duration have changed. Recovery periods have shortened compared to early cycles. Institutional holders operate under mandates. They allocate based on risk models, correlation, and long-term objectives. They don't react to short-term price swings. Corporate treasuries holding Bitcoin follow structured policies. Purchases are scheduled. Sales require board approval. During market stress in 2024 and 2025, on-chain data showed fewer large panic-driven transfers compared to earlier cycles. This shift affects Bitcoin dominance as well. In previous cycles, capital rotated quickly from Bitcoin into smaller assets after major rallies. Recently, Bitcoin retained larger market cap share for longer, reflecting its role as the primary institutional entry point. By 2026, Bitcoin's behavior increasingly links to macroeconomic variables rather than retail speculation. Inflation expectations, interest rate policy, and currency stability play larger roles. Bitcoin's correlation with liquidity indicators has strengthened. When real yields rise, pressure increases. When liquidity expands, demand improves. This macro sensitivity aligns Bitcoin with long-duration assets rather than short-term trades. With each halving, daily issuance as a percentage of total supply declines. By 2026, over 95% of Bitcoin will already be mined. New supply becomes marginal. As supply tightens, long-term holders gain influence. On-chain data from previous cycles shows older coins move less frequently after halvings. Coins held over 1 year tend to remain dormant longer as issuance declines. A market strategist told Reuters that Bitcoin is moving from a reflexive retail market toward a capital allocation market. This transition reduces extremes but extends time frames. Moves unfold over months instead of weeks. ETF flows add another layer. During volatility, ETFs can slow price swings by absorbing supply. During expansion phases, they amplify demand. This doesn't eliminate cycles, but changes their shape. By the time 2026 arrives, the halving itself will be in the past. Attention shifts toward positioning, macro alignment, and capital rotation. This phase historically confuses participants, expecting either immediate collapse or explosive growth. Instead, data shows extended consolidation zones, often misread when they're actually transitions shaped by structural changes. Bitcoin's evolution after the halving isn't driven by a single event. It unfolds through minor behavior, capital flows, institutional holding patterns, and macro conditions. By 2026, those forces will dominate price action more than speculative narratives. The halving reduces supply predictably. ETFs alter demand through regulation. Institutions change volatility through holding behavior. Together, these factors define the post-halving environment few market participants fully anticipate. Bitcoin in 2026 won't look like Bitcoin in 2013, 2017, or 2021. It will look like a maturing asset class, transitioning from speculative instrument to macro-sensitive store of value, with supply dynamics favoring long-term scarcity over short-term volatility. Subscribe to the Crypto IQ. Next week, we're examining which macro indicators, actually predict Bitcoin moves in institutional-dominated markets and how smart capital positions before liquidity shifts reshape entire cycles. We'll see you in the next deep dive.